Hello everyone, welcome to another finance update with Djji Tutorials. Today we are defining what is a TFSA, what it is used for, and the downsides. A tax-free savings account, or TFSA, is a registered account used to save and grow money tax-free. It allows Canadians to set aside funds for various purposes like retirement, education, or a home down payment, with the earnings and withdrawals being tax-exempt. The TFSA program began in 2009. It is a way for individuals who are 18 years of age or older and who have a valid social insurance number, or SIN, to set money aside tax-free throughout their lifetime. Here's a more detailed explanation. Tax-free growth. Earnings within a TFSA, including interest, dividends, and capital gains, are not subject to taxes. Tax-free withdrawals. When you withdraw money from a TFSA, you don't pay any taxes on the withdrawals, including the original contributions and the accumulated earnings. No tax deductions for contributions. Unlike RRSPs, contributions to a TFSA are not deductible for income tax purposes. Flexibility. TFSAs offer flexibility to save for various goals and withdraw funds at any time without penalties. Available investments. You can invest your TFSA funds in a variety of eligible investments, such as savings accounts, GICs, mutual funds, stocks, and ETFs. Contribution limits. Each year, Canadians have a limited amount they can contribute to their TFSA, which is determined by the Government of Canada. Annual limits. The annual contribution limits for TFSAs have changed over the years, but you can find the current limits on the Canada Revenue Agency website. Contribution room. Any unused contribution room from previous years can be carried forward. Withdrawals and contribution room. Withdrawals from a TFSA do not reduce your contribution room for the future years, but you can contribute up to your available contribution room. A primary downside of a TFSA is that contributions are not tax deductible, meaning you won't receive an immediate tax break when contributing. Additionally, if you over-contribute, you'll face a 1% tax penalty on the over-contribution amount each month. Furthermore, while withdrawals are tax-free, they reduce your future contribution room, as you can't recontribute more than you withdraw. Finally, TFSA assets are not protected from creditors if you have debts. Here's a more detailed look. No immediate tax deduction. Unlike RRSPs, contributions to a TFSA are not tax deductible. This means you don't get to reduce your taxable income immediately, which can be a disadvantage if you are in a high tax bracket. Contribution limits. There are annual contribution limits to a TFSA, and any over-contributions will result in a 1% tax penalty per month on the over-contribution amount. Impact on future contribution room. When you withdraw money from your TFSA, you lose the corresponding contribution room. This means you cannot recontribute that amount in the future, which can be a disadvantage if you need to save for the future and you've withdrawn a significant amount. Not protected from creditors. TFSA assets are not protected from creditors, meaning they can be seized if you have debts. This is in contrast to other investment accounts like RRSPs, which may have some creditor protection. Losses cannot offset gains. Unlike non-registered accounts, investment losses within a TFSA cannot be used to offset gains in other investment accounts. Day trading not allowed. The Canada Revenue Agency, CRA, considers day trading to be business income, and it's not allowed within a TFSA. If you are a student and want to know more about TFSAs, speak with a financial advisor or your local bank. Don't forget to tune in to another session on finance. Like, share, and/or subscribe for more updates. Thank you for watching.